Hey there, how you doing? Welcome to the channel. So today we do a little stock market update and then going to talk a little bit about the Biden proposal to increase capital gains and why I think this is probably not a good idea. But that's just me. So basically, beyond the fact that raising the capital gains kind of squished the market today, let's see what's going on. So basically, the SPY is still in a big uptrend, but today it did kind of have a big red bar. Gee willikers, let's go to the 3-month. Yeah, so it really just went off 1% right out of the gate on hearing about that. Consumer staples didn't go down as bad. One thing that was Bitcoin here now, Grayscale Bitcoin Trust. Now, once I saw this today, I was like, that's it, I'm done. And this is not financial advice. This is what I'm doing. I'm done. I bought some over here, sold some here, and today I just sold more because that was just a really bad bar. I had been talking about how like, well, I don't want to sell because, you know, every time it had come down below here, it had kind of found some support. But this time it was like, no, I'm liquidating it for now. So once again, it's something where I'll certainly come back to this. It's definitely what's going on here is more, there's a lot more going on here than meets the eye. But just for the short term, I'm not going to take that much pain, you know, so I'm going to try to get out. I did get out and that's what I did. And we'll see, you know, I mean, this thing could come back down to 20, whatever, you know, and still be in a bigger uptrend, whatever, but we'll see. Let's see what GME do much today. Interesting that silver yesterday was peaking up and today went down. And do we get any help on? Yeah, we got a little bit of. So we got this. The VIX kind of spiked up today, so that went up 9%. So I mean, this is the idea behind this. If the market does put in like a quick correction, then or a pullback, you know, of significance, then this hopefully will pump up a little bit. But we'll see. We'll see. And then Tesla. So Tesla, I had bought this yesterday, and then I'm sorry, day before yesterday, and then yesterday looked good, and then today it kind of looks crappy. So I just sitting on it right now. Gee, the earnings are coming out for 26, which is next week, early next week. So I don't know. I'll have to look at that tomorrow and figure out what to do. But part of the issue is that because, you know, Bitcoin would be, you know, basically capital gains on Bitcoin, blah, blah, blah. That would be kind of potential an issue. And if we looked for the let's try to go to some of the high beta, you know, like the NASDAQ. See, now it's interesting. See, the NASDAQ now didn't really completely come back to its uptrend. I mean, it sort of has the uptrend on the weekly chart, but you know, it didn't put in a new high yet, and it kind of got its knees capped today. So that wasn't really great for that. Churchill. Let's see how some of these other end phase. What is this guy doing? Yeah, this got a gap up and then kind of, wow, they just kind of squelched it down, but still held. So Nakamoto, Poo-Poo, Neo. Oh, it didn't get hit that bad. XPEV, just curious here about some of these guys. Yeah, not really much happening. All right, well, let's go over. So that was kind of what happened in the market. You just kind of wonder what's going on with that. But yeah, so now I want to just talk about the, so I guess the proposal, currently the capital gains tax rate is, I believe it's about 20%. I was reading today, 20%. And the proposal by Biden is, or the rumored proposal is to crank that up for people that are rich and basically somehow people making more than $1 million or worth more than $1 million, something like that. That's a good question about exactly whether it's going to be worth some kind of net worth thing or whether it's going to be now obviously this is all early and it's negotiable, right? So this is something that he's throwing out there, but basically it would put the capital gains tax rate up to basically in the 40 something percent range. So basically right now, like if you hold an asset, and I'm not a tax person, but this is my general understanding, so go check with your tax person. But generally, if you hold an asset like a stock or some other asset and you hold it for more than a year, it's considered capital gains we would say long-term capital gains. And then what happens is it doesn't get taxed at your rate that your wages get taxed. You get this taxed at a potentially a lower rate, which in this case sounds to be 20%, right? So now, of course, there's, I mean, I acknowledge there's legitimate people are frustrated with this because you have people, the very wealthy, like don't work for a salary, right? So they're not out there working, they're not making $100,000, $1 million, whatever, I mean, one of the famous cases would be when you looked at like Steve Jobs, he went back to Apple at some point. And my understanding was, from what I remember, he took a salary of $1 a year. And of course, well, it's crazy, right? But he's a multi-millionaire, maybe a billionaire, but probably just millionaire. And, well, why does he do that? Well, he has to take some salary. By law, you sort of have to take some salary. But the other thing about it, too, is that what happens is, they're doing it for the capital gains, right? So what he's doing and he's playing is a totally different game. He's playing a game of, basically he has a bunch of stock in the company, and his play is to, get rewarded if the stock does well. That's sort of what the game is, and that's the game of the, the very wealthy. And so when the assets that they hold, like the stock that they own, if it goes up a lot, they get taxed at a lower rate than potentially someone else because they get taxed at a 20% rate. Whereas if that was coming in as a salary, they would get taxed at a higher rate. They would get taxed at, whatever, like 39% or whatever it is right now. And so the point is Biden is basically getting rid of, it sounds like his proposal is to basically, it's going to get rid of capital gains. And the capital gains right now, you don't get to take advantage of that unless you hold the asset. My understanding is a minimum of a year. So there's a couple problems with this. It's like, I get the part that people are complaining. They're complaining that, like, okay, the rich don't pay enough, right? Because you have this situation where it's like, oh, the rich don't pay enough taxes, blah, blah, blah. Even people like Buffett have made this statement, like sort of a nonsensical statement that, like, oh, he pays less taxes than his secretary, and kind of nonsense statements like that. It's not really true, but so there's been this push to be like, hey, look, you need to tax the wealthy more, and one of the ways to do it is to, they consider it like a loophole. Capital gains is a loophole, but there's certain things to keep in mind about that. It's a real big issue, because what's really going on there is, if you think about capital gains, it's an investment, right? And so if you're investing in a business or you're investing in something and you're making a commitment for like a year, what you're doing is, you have to understand that with capital gains, you're risking your money. It's like you're at risk of losing that money. So therefore, you have to understand that there should be a benefit for doing that. Like, I work for a salary, right? And when you work for a salary, now people that are, I mean, look, you're taking no risk, right? If you're working for a salary, you can pretty much screw that job up so bad. What's going to happen? You get fired, right? That's it. But you're not going to lose money. Matter of fact, the first thing they're going to do if they fire you is they're going to make sure they pay you, because they don't want to get in trouble with the labor department from whatever state you're working in, right? So you're taking zero risk. So if you're taking zero risk, you should definitely be taxed at a higher rate, because you're taking zero risk. Now, the problem is with capital gains, you're always taking risk. If you're investing in some kind of a private company, if you're investing in real estate, if you're investing in stocks, there's a risk that you will lose that money, right? There's a risk that you're going to lose that money. So therefore, you should have a benefit. This is something that we should encourage. We should encourage investment, and that is better for our country. We have this problem where we have, this, people talk from both sides of their mouth. They're like, hey, oh, the stock market is too short-term focused, need to focus more long-term. Okay, great. Well, and now we get a proposal like this. Well, obviously this makes no sense. What is this going to do? If holding a stock 1 year or 5 seconds makes no difference tax-wise, you're going to pay a salary on it, then what's the benefit of holding it longer? Why would you hold it longer? What do you think that is going to do to the stock market? Besides the fact that it's probably going to sell off somewhat because people are just going to try to find a better place. Like if they don't close loopholes, they don't close some of the tax things on real estate, there's going to be a huge run of money into real estate, which is actually a problem. But, so going back to that, like, what is the problem? The problem is like short-term thinking, and all that tax proposal is going to do what? It's going to encourage short-term thinking. It's going to encourage people to like, okay, well, I just want to, there's no point in holding this investment any period of time. I'm just going to like day trade it worse than people are day trading now. I mean, you have to understand what people that have money and stuff like they tend to, because they have so much in such large portfolios, they tend to actually be a little bit more long thinking, and they do create some stability in the market. You have to understand, it's like it's the Robin Hood kids and the high frequency guys that are like out there just trading on trading really fast, not holding anything. And this stability that you get in the markets is due to this certain group of people that are like, look, I just don't want to hold they're like, I don't want to hold cash, and I need to hold something, and I want to hold it for a long time. And you get the benefit of capital gains when you do finally decide to sell, that, you get a decent tax rate. So now it's just disincentivizing that type of investment. And remember, I know the stock market is speculation, and I've stated that before, and there's a lot of speculation, but you have to understand the purpose of it behind the scenes. The purpose of it is really to help form that capital to invest. I've worked at startups before, and trust me, if you've ever done that, it's like, oh, they're looking for that round of funding, and you're like, and that was always the question at all hands meetings. What are all the questions? The question are like, hey, how's the fundraising going? It's like they just did a round B, and it's like you're already like, well, how's round C going? Because everyone knows if they can't raise that money. And everyone's working a lot. Everyone's working really hard, but it's just the knowledge is that, hey, it's going to take time for us to get the product out. We need that fundraising. And so once again, so this, we'll see what happens with this if this Biden's proposal kind of goes through that way. I suspect, given the current climate, that it probably will. I mean, I get the idea that, look, that's going to be the question. I don't know if you make $1 million or worth $1 million. See, if it's just people that are worth $1 million have to pay that higher capital gains tax rate, that's going to be bad, because the average person in their 40s to 50s should have $1 million. Most don't, but they should for retirement, the way things are. Yeah, I mean, if you had a chance of retiring, you should have $1 million in your 401k. Is that going to be counted on it? I don't know. So I think or if it's salary, there'll be some manipulation of that as well, because people can like, well, don't take the salary, take the cap gains. Like if you're going to take salary, that would push you over that limit if it turns out to be salary. So I think it's a really bad idea. I think that I get the idea. I get the concern. I think a better idea would be just leaving things as they are. And if you say like, hey, look, rich people are taking too much, then raising that rate, like you took it from 20% to 25%, that I think would be more palatable, because that would be like, okay, yeah, I'm paying more on the cap gains. Everyone's paying more on the cap gains. And sure, we don't like it, the people that have, that are making the money. But on the other hand, it doesn't create an entire new structural shift. The problem with these, some of these proposals, it basically, this proposal just like entirely eliminates capital gains. There's like no more capital gains anymore. And so it's a very structural change. And these structural changes are very prone to hiccups, because it just, everyone has to adjust, and everyone has to adjust very quickly to the new setup. And trust me, I know you're all thinking like, well, screw them, whatever, and blah, 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 and blah, blah, blah. But it's like, look, it'll end up coming back on you as well. It always does. So, Yeah, so I just wanted to bring that up because I know that in, I'm not a rich person at all, and I'm just a working guy at work. But the point is, well, it kind of sucks. It actually kind of going to suck because, like, why should I have to pay? How is that going to work too? It depends. Like, are we still going to be sheltered in retirement accounts, or are we going to have to start paying in retirement? And I think the final thing to keep in mind is that it's not going to resolve anything. This stuff is all basically, it's more about retribution. And the reason it is because it won't resolve any issues. I mean, the budget deficits the spending is so unsustainable that the money just has to be, printed out of thin air. We can never pay the debt off that we have in the US. It can never, ever, ever be paid off. It's just not mathematically possible at this point. It can never happen. And so therefore we're on a permanent, pile of debt that's going to keep growing until it just finally becomes unsustainable. And then the system that we know it will implode. And this is, of course, where you get the World Economic Forum and stuff. They're kind of smart. They're also very devious, but they know this too. They're like, yeah, no, I mean, just look at the US. It's like, it's not sustainable. I mean, it's not going to. And then the question is, will the US exist? I mean, there's bigger questions here. Like, will the US exist after this? And the answer may be, well, I think it will, but, we're going to be much weaker because you just can't spend this much, live beyond your mean. This concept that we're basically kind of switching to UBI, in a way, it's just not going to work. And the money that you're spending so far outweighs any tax increased revenue from taxes from things like this that it doesn't even move the needle. And so that's where so then why are they doing it? Then obviously it's this retribution. It's to say, well, we're just mad at you because you're successful and made a bunch of money. We're mad at you. That's what it really is. And that's why we want to punish you, because we're mad at you. That's really what it comes down to. I mean, it doesn't resolve any of the budget issues that we have. It doesn't resolve any of that. The simple fact is that, when you look at, if you look at, like the total wealth of like the 400 richest Americans, like Forbes has this list of the 400 richest. I don't know if it's the world or Americans, but just assume they're all Americans for now, which is not always the case. But, it's something usually comes up with like a couple trillion. I think the last time, even if it was $3 or $4 trillion was their total net worth, you have to understand what that is. That's just the value of their businesses. That's the value of, basically a lot of its stock holdings or valuations on companies, et cetera, et cetera. It's not real cash. It's not like they have a billion, $100 billion of cash sitting there. And you add that all up and you have something like $3 or $4 trillion. And we're in a deficit. We're spending like, I think, at least $3 trillion more per year. And you're talking about comparing it to the rich people that's their whole the whole net worth, that's their lifetime net worth, is like $3 trillion, and we're in deficit $3 trillion a year, something like that. So it doesn't even move the needle. So I mean, I get it. You're gonna do this tax thing, and I'm sure something like it's gonna pass because it's just very popular right now. But it's not going to resolve any budget issues. It's not going to do anything to resolve any of that. And then why? Because the spending is so out of control, right? The spending is out of control. We're spending $3 trillion more. And if you basically took, and this is what I'm saying, I know people don't read Dickens, A Tale of Two Cities. I mean, I think it's a great book from a long time ago, but it's fictional, but it's set in the the French Revolution. And it's A Tale of Two Cities because it's set with the main characters being in Paris, France, where the revolution is going on, and then also in London, England. And in there, it gives a really good depiction of, kind of what was going on at that time. And it's not fun. The guillotine, it's basically just people get called out, people getting murdered. It's like it was no doubt that the elite class of that time was brutal. The scene in there where the guy's just like runs someone over and kills them in his chariot and just doesn't even bother stopping. I mean, I'm sure that happened a lot because they had no respect for the commoners, et cetera, et cetera. But then on the other hand, when it's like, okay, now it's like the new boss is in charge, right? And is the new boss like enlightened in any way? No, the new boss is what? The new boss is doing what? The new boss is like got this new thing called the guillotine, and they're just using it. And remember, they were killing everyone. They were killing, they're killing the elite, the rich, and their entire families. So it was not necessarily uncommon to be like, oh, the 6-year-old girl, the kids get guillotined as well. And kind of interesting. I don't know which one they guillotined first. Do they guillotine the kids so the parents get to cry watching the kids get guillotined? I don't know. But the point, that's kind of, it's retribution. That's what it's all about. So I don't see retribution as an answer to anything. So this, if, I'm not like overly pessimistic about this proposal from Biden. I think that, it's possible that it will, that there'll be some kind of compromise that makes sense. And like I said, if you just change if you put like, say it's 20% now, put it to 25% for everyone, and 30% if you make, something like, basically if you're making more than $1 million in cap gains, then it goes up or something like that. Then that can be more more handled more easily. But I think that, you want to keep that, you got to keep something about time. You got to encourage a little more longer thinking. And to do that, you want some kind of tax incentive there. You don't want to just tax everyone at their wage rate. All right. So that's my view on this proposal. It was interesting. It kind of was hitting the market today because there's going to be a lot to figure out, But I think if you're, one of these people and you're, all for this because, you're upset and, and you think that it's trying to level the playing field. You know what I mean? It's really not. It's really not. I remember like a long time ago, there was this thing. And so I want to kind of explain how this works, how laws work and how regulations work and how it really doesn't help you, even though it's sold to you as helping you. There was this back in the 2000s, there was this thing called the market timing scandal. And what was happening was big hedge funds and investment funds were able to basically go to, let's say a Janus fund or some other mutual fund, and they were able to buy the mutual fund shares, but they were able to buy them like after the close, after it already moved up at the morning price. And no one else could do this, but they were like privileged customers. And so they would basically, there were certain mutual funds that were allowing them to do this. So think about it. You had stuff back in the tech boom, you had stuff where like the stock market would go up 2.5% that day. And okay, so these guys would go and say, oh yeah, we want to buy 100 million or a billion of your fund, your NASDAQ fund. Like, okay, you can. Well, we want to buy it to open. And like, okay, fine. So basically they buy it or immediately, because they get priced at the low of the day, they immediately show a 2.5% profit. And then they wouldn't even hold on to it for very long, for a few days, whatever. And then they'd sell it and take the money and run. And this was big institutions. This was not people. There's not little people doing this. Now, I remember I was working at this place in Florida, and there were guys that were, yes, they were trading, but they weren't doing anything legal, and they weren't doing anything immoral or unethical. All they were doing is saying like, hey, I'm going to buy this fund today. Oh, it goes up. I know it's like going to come down because it's going up way too fast. And they just sell it and move it to another one. They were trading, moving their funds around all the time, but they always had to pay the price. If they always had to buy it at whatever the current price was and sell it at the current price. And basically it would be the close, right? Everything would be done at the close. So they didn't get any benefit. So what happened? So the consequence of these privileged funds basically stealing our money. So like if I owned the NASDAQ fund, and this NASDAQ fund was basically getting stolen from by these large customers who were basically, hey, I'm going to buy your thing today at the open, and then I'm going to sell it tomorrow with a guaranteed profit of 2% of my money. who's getting screwed? Well, the rest of us that own that fund. It's an expense. We're losing our money, right? Because they're taking that money out, and that money is not there to be reflected in the fund and our gain on our shares of that mutual fund. So we were getting screwed. But what was the result of regulation? The result of regulation is like, oh, we're going to stop this market timing crap. So we're going to force people to hold mutual funds for 30 days, 60 days, 90 days. So now if you're like, hey, okay, I got some money and I need to, put it into mutual funds, and you're like, you put some money in and then you have to sit, you can't and they were like charging a fee. So you had to hold it for 30 days or 60 or 90 days. And if you sold it before, they charge you, some of these places would try to charge a 5% or a 10% penalty. I mean, think about it. So if you're sitting there and you made a mistake, you put your money in and you needed to take it out for some reason, or you put it in and then the market goes to crap and you realize like, oh my God, this was like a disaster. I need to get the hell out. They're going to charge you an extra 10%. So that's the kind of regulation that they did. That's the kind of stupid stuff that they did. So here it is. What did they sell that regulation as? And there may have been a law involved with it too. What did they sell it? Oh, we got to protect you. We're protecting you. And they did not protect you. They hurt you. How many people got screwed with unwanted penalties? And also think about it too. This was applying to everything. So this is like, oh, gee, you're putting money in every week or every 2 weeks as part of your salary. And it's like, oh, well, I'm changing jobs and, oh, I got to move to another employer or move it to another fund. And it's like, oh, I get whacked with the fee on that too. So of course, what happened? The result of that is we got screwed. The little guy got screwed. The big guys, there was maybe some penalties, but nothing. They made more than they paid in penalties. It's like an entry fee. And then we get screwed. Now, the only thing that happened out of it is like ETFs became the thing, right? So basically ETFs became the thing where it's like, because everyone's like, hey, look, I don't want to own this thing forever. Especially because think about it. You had some mutual funds that are like, oh, it's a European high beta fund, or, all these different funds that you don't want to own forever. You just want to like buy them for a period of time. And so you don't want to hold them 90 days, that kind of a thing. So that's why I am very skeptical. And that's why, like, when you're talking about something basically that's as radical as Biden's, like basically getting rid of cap gains, I think it's going to be very bad, really, for everyone. And it's just going to be a little notch of, another little notch in competitiveness and downfall of our country in many ways. It's not going to solve any of the problems. There will be no more money into the government that could be used to actually help you. I get it. I know people that are struggling paycheck to paycheck and really struggling, and I get it. But, this won't resolve that issue. So that's it for this one. We'll see what happens, but